So Chapter 9 looks at our reporting and the analysis related to those assets that we have that have a longer life. That means that they are not going to be consumed or used in the course of one operating cycle. They're sticking around a little bit longer. Talking about multiple year time periods. As you move through this chapter, you should be able to explain the accounting for our plant asset expenditures, apply depreciation methods to those plant assets, explain how to account for the disposal of the plant assets, identify the basic issues related to reporting for intangible assets, and discuss how long-lived assets are reported and analyzed. Plant assets, also known as property, plants, and equipment, are resources that have physical substance. They have definite size and shape. We can actually touch them, and they're used in the operations of a business, and they're not intended for sale to customers. It's important that companies keep these assets in good operating condition, and they replace worn out or outdated assets and expand their productive assets as needed. These assets are expected to provide service to the company for a number of years and are also known as our fixed assets. Plant assets are absolutely critical to a company's success. These are the actual assets that the company uses to generate the revenues that lead to net income. So if you stop and think about it, Wendy's cannot sell hamburgers if they don't have grills. They cannot sell fries if they do not have fryers. They cannot ring up those orders if they don't have cash registers. So these are the things that need to be in place in order for you to generate your revenue. That's what plant assets are. And as a percentage of total assets, for many companies, plant assets represent a significant portion of that. We're going to look more deeply into plant assets and how we handle those, all the way from establishing what do we record them at, and what do we do with that once they're on the books. That's what this chapter talks about. So when we acquire an asset, we purchase a delivery vehicle, we purchase a grill because we're Wendy's and we need another one. We have to determine the cost, and we use the historical cost principle. It is what is required of companies to record our plant assets. Cost consists of all the expenditures that are necessary to acquire the asset and to get it ready for its intended use. If a cost is not included in a plant asset account, then it must be expensed immediately. Such costs are referred to as revenue expenditures. Costs that are not expensed immediately but are instead included in the plant asset account are what we refer to as capital expenditures. Cost is measured by the cash that's paid in a cash transaction or by the cash equivalent price paid when non-cash assets are used in payment. The cash equivalent price is equal to the fair value of the asset given up or the fair value of the asset received, whichever is more clearly determinable. Once the cost is established, it becomes the basis of accounting for the plant asset over its useful life. So when we talk about cost being the actual price plus the expenditures needed to bring it to its intended use. So for example, you purchase a delivery van, but you need to have special winch put on, you need to have the logos put on, you need to have the radio installed. All of those other things that need to happen before it can actually be used in operation are part of the historical cost. So those are part of the cost of that plant asset, and you recognize that as a capital expenditure portion on the balance sheet. Now there's one little quirk, which is land. Land is often used as the building site for a manufacturing plant or office. The land is considered separately from the building. And the cost of the land includes the cash purchase price, closing costs such as title and attorney's fees, the real estate broker's commissions, any accrued property taxes or liens that have to be assumed by a purchaser, and the necessary costs incurred to make that land ready for use all go to the land account. So let's look at that a little bit more in depth. We have Hayes Manufacturing Company who acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is raised at a net cost of $6,000. It actually cost $7,500, but we were able to sell some of the salvaged materials for $1,500. There were some other expenditures related to this transaction in the form of our attorney's fees of $1,000 and our real estate broker's commission of $8,000. So let's figure out what the reported cost of the land on the balance sheet needs to be. We start with a cash price of $100,000. Before we could use this land for anything, we needed to remove that old broken down warehouse. So we add $6,000 to it. We have the $1,000 in attorney's fees and the $8,000 in the real estate broker's commission for a total cost of land of $115,000. So when we see the land on the balance sheet, it's going to be at the amount of $115,000. Next, let's move from the land to what's called land improvements. Land improvements are structural additions that are made to the land, like driveways, parking lots, fences, landscaping, underground sprinklers. Land improvements include all expenditures necessary to make their improvements ready for their intended use. The cost of a new company parking lot includes the amount paid for paving, fencing, and lighting that parking lot. The total of all those costs would be debited to the land improvements account. Because land improvements have limited useful lives, companies will expense or depreciate these costs over those useful lives. Parking lot's not going to expire in the course of a year. It's going to be after a certain amount of years. The fence, the same way. We will recognize those costs over the course of the life of the asset. Continuing to build up, we started with land, went to land improvements. Next, we would have a building. Buildings are facilities used in operations such as stores, offices, factories, warehouses, airplane hangars. We include in the cost of buildings all necessary expenditures related to the purchase or construction of a building. When a building is purchased, such costs include their purchase price, closing costs, attorney's fees, title, insurance, etc., and the real estate broker's commissions. When a new building is constructed, its cost consists of the contract price plus payments made by the owner for architect's fees, building permits, and excavation costs. The inclusion of interest costs in the cost of a construction building is limited to those interest costs that are incurred during the construction period. Now we have a building in place. Now what else do we need to generate revenue? We need the equipment for whatever it is that we do, whether it is sales or manufacturing, service, we would need equipment. Equipment includes assets that are used in the operations, such as store checkout counters, office furniture, factory machinery, delivery trucks, airplanes. And the cost of equipment consists of the cash purchase price paid, sales tax, freight charges, insurance during transit paid by the purchaser, as well as any additional expenditures required in assembling, installing, and testing the unit to prepare it for use. Two criteria apply in determining the cost of equipment. The frequency of the cost, is it one time or is it recurring? And then the benefit period, the life of the asset, or 1 year. So let's look at that a little bit more in depth with Leonard Company. Leonard Company purchases a delivery truck at a cash price of $22,000. Related expenditures are sales tax of $1,320, painting and lettering of $500, motor vehicle licenses of $80, and a 3-year accident insurance policy of $1,600. So they want us to compute the cost of the delivery truck. Well, first we have that cash price that we paid to actually acquire it of $22,000. We have the sales taxes related to it of $1,320. We had $500 in painting and lettering. For a total of $23,820. The $80 a motor vehicle license is an annual fee. And the 3-year accident policy of $1,600 is also a recurring fee. Those are regular, ordinary expenditures. So let's look at the journal entry that we would encounter to record these costs. We have $23,820 to the equipment. We have our license expense of $80. We have our prepaid insurance because it's going to cover 3 years. We'd allocate that as it's consumed for total cash payouts of $25,500. Now, during the normal life of plants, property, and equipment, there are going to be regular cash payouts and ordinary repair expenditures to maintain the operating efficiency and the productive life of the unit. Ordinary repairs are typically fairly small amounts that occur frequently through the service life. Some examples are like tune-ups and oil changes, painting of the building, replacement of worn-out gears on factory machinery. These will be debited to the repair or maintenance expenses as they're incurred. Also related to expenditures that may occur during the useful life are additions or improvements. And these types of costs are incurred to increase the operating efficiency, productive capacity, or the expected useful life. So because it is adding to it. They are typically material in amount. They don't happen very frequently. Additions and improvements will be debited to the plant asset account affected and generally increase the company's investment in their productive facilities. Additions and improvements are called capital expenditures. So, types of additions and improvements. The overhaul of a truck engine versus basic maintenance. This is not going to happen frequently, and when we do an overhaul, that is going to add to the life of that truck. It is going to be useful for a longer period of time than originally intended. Here we have another anatomy of fraud. I want you to go ahead and pause to read this, and then restart to read what the missing control is. An alternative purchase, or an alternative to actually purchasing an asset, is leasing. In a lease, the owner of the asset, the lessor, allows another party, the lessee, to use an asset for a period of time at an agreed upon price. Some advantages of leasing an asset versus purchasing it are reduced risk of obsolescence, little or no down payments, shared tax advantages, and then assets and liabilities are not reported in operating leases. An operating lease is an arrangement allowing the lessee to account for the transaction as a rental, with neither an asset nor a liability recorded. Under a capital lease, the lessee shows both the asset and the liability on the balance sheet. The lessee accounts for capital lease agreements in a way that is very similar to that of a purchase. The lessee shows the leased item as an asset and the obligation owed to the lessor as a liability on the balance sheet. And then the lessee would depreciate the leased asset in a manner similar to that of the assets of which they have purchased. Leasing is really a huge business. And leasing was definitely an issue in accounting for quite a bit of time until we received additional definitive guidance regarding capital leases and how those had to be accounted for.